Hello, ladies and gentlemen. Welcome to the third episode of Bar the Dips. Very excited to have with me today the captain of the ship at Pepperstone in terms of research here, Chris Weston, or as I like to call him, Westy. Today we've got a jam-packed session of content, so we're going to dive straight in. So Westy, we like to crack things off here with just getting a bit of background on the guests. So tell us a bit about yourself, how you got into the world of finance, and a bit on your background, etc.
Yeah, thanks, Luke. I kind of fell into it because the rugby captain was one of the big traders in the city in London, and he sort of saw me not really going anywhere at university, so he sort of pulled me into one of the banks in Cabot Square in London. Worked for a US bank for a couple of years before moving into another US bank. This time out in the city of London on the buy side, Merrill Lynch Investment Managers. Where I was trading commercial papers, CDs, money markets effectively, and some FX. It was more on the hedging side of things. But yeah, I moved around for a couple of sell side shops and with Malim before I moved over to Australia in 2005 and followed the heart effectively. She's now my wife, and moved really from what was institutional sort of trading roles more into retail derivative products. This is where we are today in CFD land. I started off there managing a book of clients, premium clients. We set up the premium client desk there at a competitor, managing clients through the GFC. And that was a real experience, people going from a situation, certainly here in Australia, where, from 2002 to 2008, people were just buying stocks because they're going up, and certainly mining stocks. And a lot of people in Western Australia just really only saw markets only going one way, so they wanted to use leverage to buy stocks effectively, and that was working really well for a large period of time. Of course, then the GFC hit, and they were buying all the way down. So we had to change people's perceptions to understand shorting and trying to make market money in both markets. And I think really just through the navigation of clients and having an understanding about actually what was going on in the plumbing, people were talking about TED spreads and various factors and interbank borrowing costs. And a lot of these factors were very new to a lot of retail traders, and the ability to try and, tell people these on a very short-term basis and understand these more simplistically, open their mind to different opportunities. And so we started a research team, and that's where I sort of moved across from a competitor to Pepperstone, and that's where I am here today with you and your lovely voice. So that's kind of what we're doing. So it's really trying to understand global capital markets and trying to break it down into the nitty-gritty of flows, into positioning, into volatility, and really trying to make money from the financial market short term. That's what we're here to do.
Great answer, Westy. That's nice to get some color on your background. They're very interesting stuff. The rugby captain getting you into the financial world. Okay, so knowing what you know now, what is the one thing you wish you could tell mini Westy when you were starting out?
Well, I'm lucky because, I started off in the financial markets at a young age in the late 90s, and then as I sort of progressed, I sort of learned and got my academic background through that, and started getting into applied finance and masters and those factors. So, I think I sort of took a slightly less traditional route than going through, a good university and getting a finance background and then getting into banking, with 500-600 other people trying to get those same jobs. But I think, the way as I get older, life I try to make life a bit more simple. And I think for me, what really interests me is statistics and making understanding movement, like volatility, for example. And I think as time goes on, the idea of trying to automate systems and strategies is something that really appeals. So therefore, having an understanding, and had I known what I know now, and could have continued to go through a financial channel, certainly understanding statistics in a much higher degree capacity, being able to code and apply those concepts into very complex models, I think would have been somewhere I would have liked to have gone. I'm in awe of people or quants. I'm in awe of people who trade volatility. I understand the world that they live in, but not to the same sort of degree that these guys are trading in terms of those really complex derivatives. Whereas we're in a very vanilla world. So that's a kind of an area that I would have loved to have gone in, and now I've got 3 children. It's very difficult to get into that, to have the time to even put that situation there. But I mean, I think probably the first thing that we need to understand when we're trading, and what I'd love to have learned in that situation is to take a loss. It's just, if I can tell anyone who's getting into the game, if I look at any losing client who's a churn client, someone who is just going to who blows up, it's always the same thing. Either they've decided that they don't want to be in the markets, or they've just lost money. Why did they lose money? Because they can't take a loss. So for me, the first thing I would have loved to have learned, and we all learn bad lessons over it, well, good lessons, should we say, is the ability to just take a loss. And for me now, it's really easy to take a loss. I find it incredibly easy. What I find very difficult, Luke, is and maybe this is something that you share as well, is the ability to run a profit because of the emotion that's involved in that. So I find it very easy to now cut those losses. As soon as I'm making a loss, I'm just thinking about how can I go into damage limitation mode? How can I cut this out the system? And so, I've got that side of things worked out quite nicely. I might have in my account a series of small losses, but the aim, of course, is to try and let that profit run. And when you get a winner, is just trying to etch as much out of that as you possibly can. And of course, that's where emotion comes in. It comes back to my previous answer, where I want to automate situations, because like anyone else, the ability to control that emotion in a winning trade and try and etch out as much on a winning trade is really probably the hardest thing there.
Yeah, I wouldn't beat yourself too much on the coding front, because it's only just recently become very popular. And as you say, you're now a dad with 3 kids, and it's a bit more difficult to get into the land of
that's all right. Yeah, coding. I think by the time I go to bed, I'm sitting there looking at these books of algebra and bits and pieces, and my eyes glaze over, and I've got I need a couple of weeks off work.
Westy, you touched briefly on the ability to take a loss, and the next question in the interview is, what are some of the biggest tips that you could give to new traders, as well as major pitfalls to avoid? I guess you spoke about it now, a little bit about being able to take a loss, not take it personally and internalize it, just cut it and be sort of like robotic in that sense. As you were saying, it's really difficult to know when to actually say, right, I've made enough money now, let me take my profits and run to the bank. Automating, I think, is one way to help that. But yeah, maybe you can shed some more color into other tips or major pitfalls to avoid.
Well, I think first of all, you've got to have a strategy that suits exactly what you're doing. I mean, my situation in life is very different from you. I mean, you're a young whippersnapper in London, and you've got a bit more time on your hands than maybe I do to be in front of the screens when I'm not at work. And I think your trading style has to reflect those circumstances and time in front of the screen, time in the market, and the type of activity that you want to do and what you're interested in. I think, we all cut up on and hell bent on this idea that you've always got to have a winner. We know that certainly in the macro world that we live in, that's just not the case. I mean, we can sort of get 40% of our trades right and still make money if we're working on, it's a bit of a cliche to say, sort of 1.5 times your risk reward. But then again, if you're a scalper, for example, if you're trading on 5-minute charts, 15, 30-minute charts, you might really focus on that win-loss ratio and say, well, for me, my strategy, I really need to get at least 70, probably 80%, if not more, of my trades right, because my risk reward is not going to be great. So I know really good scalpers. I'm not a scalper myself, but I know really good scalpers who scalp off 15-minute charts, momentum strategy. They've got a whole setup that they use, and then if the price breaks or opens on the next bar above that level, then they'll buy that. And then obviously there's a bit more confidence to that. But these guys will be targeting at least an 85% win ratio, but their risk reward will be very, very poor indeed. Whereas I'll go into the situation understanding that, I really, ideally, obviously, if you go in and your targets are hit and your stops are hit, you really need to be looking for about 1.5 times risk to your reward to your risk. And therefore, you don't need to be right every single time. So, I think just the ability to understand that, you really just don't have to be right all the time. In fact, you can be wrong more often than you lose, than you win. And despite that, the ability to get up, stand up, brush yourself off, and continue to soldier on, knowing that if you have enough of a sample size on your trades, and you've got that trading journal, and you understand your edge, that you can march on with a positive expectancy. And I think that's really it. So for me as a macro trader, I know that I'm not going to be right every time. It doesn't concern me. Obviously when we're putting out research to clients, we want to be right as often as possible. There's, that's our pride and our reputation is obviously everything there in terms of strategists. But when you're making money and when you're trading money and you're trying to make money from the markets, you just don't have to be right every single time. And I think that's really one of the hardest things to believe. But I think the longer you get in the markets and as your strategy becomes more defined, you'll understand that.
That sort of dovetails onto the next question in terms of what your trading strategy is specifically. Are you a trend, momentum, mean reversion, swing? I know you're not a scalper. You're more macro fundamental. But yeah, maybe just tell us a tiny bit more about that.
Yeah, I mean, I think for if I'm trading the markets, for me, especially when you're trading retail derivative products such as CFDs, the ability to move with the capital and when where the herd is all going. I mean, you may miss a bit of the journey, but what we're trying to focus on is where the herd is going. We don't want it to have been there, have got to that station, should we say? But we want to try and find out where that body of capital, that weight of capital, that herd is all going in one direction. And when we can identify that position, that's when we can have a higher probability setup. So for me, it's about identifying the flow of capital. We want to get the guts of the move. So I like to think of it more as a short-term trend kind of situation, but more momentum. I want to follow the flow of money. And, you do get a lot of people trying to pick tops and pick lows. And for me, when you're trading short-termism, is find something that's getting strong and really try and put that on the radar. And if the situation and the stars align, you can do a bit more analysis to that. Buying with a small position, and if that starts working in your favor, you add to those positions. So I've got this kind of saying that if something in your life works, you do more of it, and if something doesn't, you cut back on it. And I think trading should be exactly the same. So we're identifying something that's working. That flow of capital and the price action is probably the best way to look at that situation. And as it's working, you build on those positions. And again, if you're building on winners, what it does is it sort of changes your mindset. So from being a situation where you're trying to take the profits from a winning position, we're changing our mindset to one of, actually, we're going to try and build on that. It's very difficult to do in FX markets because we know that FX markets are generally quite short-term and mean reverting. But we've seen that working really well in some of the commodity markets. We've seen it working really well in indices. And I think, certainly in fixed income as well is something that we may touch on, is something that we've opened up now. We've got a lot of these ETFs, such as the IER, the IEF and also the TLT as well. So we can go long and short. And there's been some good trends over the time in those as well. So I think when you see the market moving in one direction, I think that can open up really good opportunities.
I think when you get a trend though in the FX markets, it's really a good one. I mean, we saw US dollar JPY at the beginning of this year when US 10-year yields started ticking up again. It was just looked like it was just going in one direction, northeast.
Well, that's right. I mean, you've just seen, Aussie dollar on the, I think, 20th of August going from around what we saw it trading 71.50 up to where it's rallied about 300 pips or so. That's a nice move to have at a time when everyone hated it. Everyone was like, oh, the Aussie dollar's going down. It's like probably the best time to buy when sentiment's so bearish in that situation. But I think what we've seen is we're now at a clear inflection point in the Aussie dollar at 74 cents, and we can talk about it later on. But there's been some really nice moves. They have been trending, but they tend to be short term and they tend to be quite aggressive. And as we talk about there, they tend to be quite mean reverting as well.
Mm-hmm. All right, Westy. A lot's happened, a lot's changed over the last year or so. I know a lot's changed for me. I'm in London at Pepperstone, no longer in sunny South Africa. So in your opinion, what are some of the biggest changes, emerging trends we're likely to see in a post-pandemic world?
Well, I mean, everyone's talking about ESG, everyone's talking about equality and various factors like that that's coming through. I mean, we've seen that now in the Federal Reserve, who are obviously targeting the labour market as their primary objective for tapering, and probably rightly so. But obviously there's technical innovations, businesses that are coming up, areas of focus. I mean, to be fair, we're still not out of the pandemic, so we're still not quite sure what's going on. I mean, we're talking about Q3 growth at the moment, and the divergence that we're seeing in Q3 growth, where, if you look at the Atlanta Fed GDP nowcast model, which is taking recent inputs into consideration, they're running the US GDP numbers at 3.6% relative to the sell side consensus, which is about 6.5%. Earnings haven't been taken down again. So people are talking about this idea of stagflation, and we're having to invest in and trade in a stagflationary world that it's been on front pages of things like Barron over the weekend. So that's something that we do need to consider. Is Q3 is looking far weaker than what people were looking for, but then everyone's expecting a snapback into Q4. So is that going to happen, and to the same extent? And what does that mean for central bank policy as well? So these sort of tectonic plates are sort of shifting around, Luke, and we're trying to understand exactly what they mean. The market hasn't shown any kind of volatility as such. Maybe that's being mispriced, and I think that we've got quite like the idea of looking at buying volatility in the short term as well. But going back to your question, I mean, I think there's still a lot of water under the bridge. I think what's interesting here is that the companies such as tech, everyone was expecting this big cyclical trade to continue working really well. Banks flourishing and energy stocks working quite well as the yield curve steepen. But really all we're seeing is at the moment is that tech continues to work, and these cash-rich businesses are just evolving because the amount of cash that they're generating means that they can just change the trend at a will. So, I don't think those businesses are going away anytime soon. I don't think they're going to change and come out the limelight. But I still think in the short term, and we're thinking short-termism as CFD traders, is what's going to be the next shoe to drop. And I think for me, it's the big question we're trying to answer here is will there be a pickup in volatility? Will the S&P break the 50-day moving average? Or are we in this continued realm for the next few weeks of this just melt up in risk assets going forward?
Yeah, no, those are some very interesting remarks there, Westy. One thing I'd add to that, a bit far afield though, is I think now with the shift to more flexible remote working, I think you're going to see a lot more demand for property in places where there's a nice climate, Croatia, Bali, those sort of things. So those are for some of the property investors out there, but a bit outside our field of FX and commodities and indices, etc. Westy, we've spoken numerous times, you and I personally, about how important position sizing is in risk management, being, a potential Achilles heel for many traders. So what sort of color can you offer on this topic? I know you touched on risk reward a little bit earlier. Stop losses, are you a fan, or do you like to sort of monitor? I know you said you like to automate things, or do you like to sort of have a gut feel if it goes to that level past a previous low? Do you just cut it, or do you like to implement a automatic sort of?
No. I mean, I think stop losses are for me, they're essential. They're absolutely essential. They are part of everyone's well, not everyone's, but they're part of the process. And what they represent to me is how much risk you're taking on in a position. If you understand how much risk you're taking on, slippage, but that's for you to manage. That's for us to manage. But when you understand how much risk you're taking on, then that's obviously divided by how far away your stop loss is from the entry point. Then you can understand your position sizing, and position sizing needs to be dynamic relative to the risk, to the risk you're taking on. Now, the risk you're taking on, in my opinion, is dynamic to the volatility and the movement in the market. So I like to use implied volatility in the options market. It tells me what markets are expecting. I mean, in the equity market, if you want to have a look at this, we can use the VIX index, and if you divide that by 15.9, then you'll get the implied daily moves in the S&P over the coming 30 days on average. But I like to use implied volatility in the FX market, so 1 week Aussie dollar or dollar yen volatility, and that's dynamic to expectations of movement. And what we can do then is work out as it's fluctuating, as people are buying and selling options, is we can do that. We don't offer options at Pepperstone, and I think probably the best, I get my prices from Bloomberg, but the best way you can do that, and what a lot of people, even pro traders, will use the average true range. And the average true range is going to be dynamic, obviously just a reflection of the range that you're seeing. We like to use the 5-day ATR, but obviously you can take that out to 20 or whatever you want to use. That's a really popular one there. So you can use the average true range, and you can use that to understand how much risk to take on. You might want to give it a bit more than a 1 times ATR. Some people like to use 1.5, but that really is depending on your time frame. If you're using daily charts and the ATR's 100 pips, for example, you're going to have a stop loss over 100 pips. So that then plays into your risk reward. If I'm taking on 100 points of risk effectively, I then need to understand that if my system works well on 1.5 times R, then I need to be looking to make 150 pips. Have a look at the chart. How long does it take, and how often does the market make 150 pips? You may be saying to yourself, well, based on historical situations, I might be in the market for a week or 2 weeks, which is significantly longer than the average hold times in our system. The average hold times for FX positions we see is about 60 minutes. So, I think that plays into it. So, yeah, I tend to look at volatility and implied volatility and also historic volatility to understand movement in a market. And that will dictate how much risk I'm taking on, which is your stop loss. You can go out and say, I'm going to have a stop loss below this low. But blindly putting it below a low is for me is not part of the system. You understand how much your risk is dynamic to the volatility in the market. And then once you understand how much risk you're taking on, you can understand, where do I target in terms of my profit and in terms of my position sizing as a factor of how much risk you're taking on.
And have you got any thoughts on using fixed dollar position sizing or the Kelly criterion in terms of formulating your how large you want that position to be? Obviously, the dollar would be in relation to your capital size, and that would give you a percentage risk per trade you wanted to put on. And then the Kelly criterion is a bit more mathematical. You're taking a sample of 50 of your previous trades and working out your win-loss ratios and that sort of thing.
Yeah, you can use a dollar, a fixed dollar position. Again, if you come out and say that my first primary objective is understand the volatility in an asset, and if the volatility is high and therefore I want to run a wider stop loss, then basically you're just taking the amount of pips, divide that by the dollar value that you want to use, and that will tell you your position sizing effectively. So your position sizing is therefore a function of the volatility and the risk you're taking on, divided by the dollar amount that you want to use as a percentage of your portfolio, and that will dictate the position size. So yeah, that's an effective one to use.
Yeah, I think that's very important to emphasize what you're talking about volatility, Westy, is widening your stop based on that dynamic volatility in the market, because I think a lot of traders sometimes can have too tight a stop, and they might have actually picked the right direction bias for the trade, but it moves slightly against them in the beginning, and they actually end up getting stopped out. So if you have a wider stop,
100%. And then of course you've got event risk as well. Event risk, which is why I like to look at implied volatility, because the event risk will be highlighted there. If you've got a major event risk like the payrolls or FOMC minutes meeting, then the market will expect greater movement. So yeah, that's part of the function as well, is holding positions over an event, and that volatility could be wider. So yeah, like you're saying there,
if you can either have a wider stop and a slightly smaller position size, or if the volatility is low and there's no event risk coming up, you can kind of squeeze that stop loss and maybe take a slightly chunkier position size.
Exactly right. They're the sum of the two, really. They're just the dollar value is going to be the same, but yeah, it's the risk and then your position sizing is taken down as a result. Yeah.
Okay, enough about the technical stuff. Let's get into the stuff that we love. So, one of the major themes in the markets at the moment is what the Fed is going to do. Can you walk us through your timeline for when you think tapering and interest rate liftoff may occur, and how do you think this feeds through into the greenback?
I'll take my screen if that's all right. Am I sharing my screen?
Let's have a look.
There you go. I think you should be showing.
Perfect. Yeah, it's sharing.
So I got a dollar index chart. It's a difficult one there as well, because the problem with dollar index is that you've got quite a lot of euro exposure. 57% of that dollar index is going to be weighted towards euro. And as we know, we've got an ECB meeting this week, and German bunds have had a 6 basis point move to the upside, because there's a lot of conjecture about whether the ECB are going to start pulling back on its pandemic emergency program. So it's difficult to say the dollar's really part of this. But yeah, I mean, we've seen the dovish taper being talked about from Jackson Hole, from Jerome Powell, and the dollar's been under a little bit of pressure. We talk about the dollar frown or dollar smile. It's kind of been the dollar frown recently. But this swing low now is obviously really important. This sort of area into sort of the 92 figure, just below the 92 figure is really key. So we've got a bit of a trend going on, which we talk about. It's trading below the 5-day exponential moving average. But I take a slightly different view now. I think we're going to see a little bit of weakness in the dollar, and I think that will be a buying opportunity, in my opinion. I think we're going to start seeing. I quite like the idea of a higher move in rates. If you have a look at 10s at the moment, we saw this outside day reversal. So the buyers came in, the sellers have moved it up, and we were just watching through for sell-off. Obviously, the market's closed tonight in the US for Labor Day, so we're not going to see that reaction. But yeah, going back to answer your question, I mean, I think
because it was an awkward. We got an awkward payrolls number on Friday. It wasn't like a Goldilocks scenario. The headline number was weak, but we saw average hourly earnings tick up, which obviously gets the inflationistas going.
Yeah, it was a tough one, mate. Yeah, it was a tough one. We would have, but I think the 3-month moving average is still above 700,000 at the moment. And so, I mean, clearly, anyone who is calling for a formal announcement in September, they've all shifted their views probably through to December. The question is will the next FOMC meeting be the stage for a formal announcement, or advance notice, advance warning, should we say, that a tapering's coming? There's a possibility that happens, that they put us on watch. I mean, certainly average hourly earnings were really strong, which is probably why we've seen the sell-off playing through. I think most people would say that all the bottlenecks that we've seen in the labour market, have held this one through with COVID, and therefore we're happy to give this one a bit of a wide berth. If you have a look at things like various other labour market statistics, which give us good insight, which we saw from the sub-surveys of, say, like the consumer confidence numbers, jobs plentiful versus jobs hard to get, it suggests that there's a lot of bottlenecks. When they free up, we are going to see an explosion back in the labour market again, which is why you have to look at the payrolls number on the 8th of October. This is the one that I think the Fed are really looking at most closely, because it will include all the stimulus effects that have worn off, and all the states now have moved away from employment benefits. It will have all the back to school situation. So people not looking for jobs because their kids are in school, that's obviously off now, and they would have been looking for work. So again, another one of those bottlenecks. The September non-farm payrolls, which comes out on the 8th of October, therefore, will be the deal. If that's really weak again, you're going to see bonds go bid. You're going to see the US dollar coming under pressure. The Fed will probably say, well, tapering's not going to happen until 2022. But a lot of people are saying that's not going to happen. We feel very confident that that's going to be a big, big number. And I'm not an economist per se, but I read their notes, I listen to their thought process, and I understand the balance of probabilities that come from this. This is what you see, any kind of research, it's don't just blindly follow it. You question the logic, you understand and read the logic. And, I quite like what I'm hearing there. And that is that, as long as we get a big payrolls number, as long as inflation remains where it is at the moment, and we don't see a collapse in financial conditions, then I think we get advance notice in the September FOMC, and I think they'll probably look to do something probably in November, maybe December. So it's a 50-50 bet between those.
Okay,
two.
so you do see then potentially tapering beginning at the end of this year, then, if the September payrolls number is nice and punchy.
Yeah, I think if we get a big September payrolls number, then that would really bring it home. I mean, there are a few red flags that are creeping up onto the global growth story at the moment. Q3, as we know, has been very poor relative to expectations, but everyone's expecting a snapback in Q4. Our job as traders is not necessarily to agree with that; it's to watch the tape and tell you what the market thinks of that. So that's what we're doing. We're not trying to prophesize tapering. We're trading what the market believes, and the aggregated flow of capital that tells you this voting mechanism, which is the markets. They will tell you what they think about tapering. rather than listen to a bunch of strategists and making calls. It's what the market does, which is what effectively what we trade. And I think at the moment, if you look at inflation expectations or other factors, if you look at the way the dollar's trading, it's certainly not collapsing. Emerging markets are doing okay. I think people are pretty comfortable with a taper, to be honest, Luke. I think the bigger, more pertinent question is how fast they taper, and if inflation doesn't continues to stay where it is, if it goes higher, big if, of course, will we see a situation where the market really tries to explore this situation, which Powell has done a pretty good job of defining the difference between tapering and interest rate hikes. He really went to town at Jackson Hole to pull those two settings apart, that tapering is not tightening and it is not a precursor for liftoff. I think at some stage, if the world continues to evolve in a positive fashion, that they may look to test that thesis, that hypothesis, and that they may look to see if this idea of tapering is actually more connected to liftoff, which could inspire volatility in financial markets. So I'm not concerned about tapering. I don't think the world needs as accommodative settings as it's got at the moment. I don't think we need 120 billion in the US of mortgage backs and US treasuries. I think tapering needs to happen. It shouldn't be seen as tightening. But as I say, the two more pertinent questions for markets is what pace do they do it at? What pace do they pull back? Similar situation as in the Europe. And when they stop, obviously that can have big implications for the supply of duration in the market, high yields. And then obviously, will we see a situation where the market tests this connection between, or this disconnection that they've tried to enforce between liftoff and tapering? And I suspect that's where you start seeing volatility.
Do you think liftoff for potentially December 2022 is a bit too punchy? Do you think that's a bit too an aggressive timeline?
Oh no, you can take the 2022 rate hikes and that's just not going to happen. And I think that's what happened. Like after Jackson Hole, there was a few people who were positioned in Fed funds futures and euro dollar futures, the tradable interest rate markets there, and they were effectively pretty long. And I think they've had to cover those positions pretty sharply there. I mean, I think they were pretty short in that situation. So they were making bets that we were going to see rate hikes coming through there, and that's obviously not happened. So yeah, I think you're looking at a world now where obviously a lot has to go right, and for us, what happens between now and 2023 could be trying to predict that. But a strategist will take a set of assumptions, and if everything goes right, then they'll say probably end of Q1, beginning of Q2, we might see the Fed look to lift off. A lot really depends on financial conditions. A lot depends on the dollar, inflation and various factors. But what we'll do is, knowing what we know now and what we believe in, we're going to price in rate hikes probably the end of Q1 of 2023. And I think that's kind of where the market's positioned at the moment.
Yeah, I know Powell's made it he's been very good at trying to disassociate tapering, the end of tapering, with interest rate liftoff. But generally, what we do tend to see is, tapering ends, and then I think they might wait a few months, see how the market digests it, and look to lift off there. I think, it also depends on the pace of the taper. If we go that proportional route, if we go 5, 10 with MBSs and US Treasuries, it takes about 8 meetings then to wrap things up. Okay. Well, speaking of central banks, we're going to be hearing from the RBA in your country, followed by the ECB this week. The question everyone's trying to figure out for the RBA is, will they do a 180 and delay tapering from 5 billion Aussie dollars to 4 billion Aussie dollars? And then we've obviously got, that punchy inflation number out of the Eurozone. Will the ECB hawks, squawks finally be heard, resulting in a taper of PEP for Q4 of this year? Give us a rundown on what you're thinking and how this could affect both those currencies, Westy.
Yeah, I mean, I had a look at the implied volatility, what the options market's expecting in terms of movement in both currencies, and it's both, pretty low at the moment. It's sort of, if you look at the 12-month range, it's below the 20th percentile. So no one's expecting fireworks, unfortunately. Love a bit of volatility, like the next trader, but unfortunately these are still pretty sanguine markets, and we're hoping for something to come alive a little bit more. So the first job is are these meetings going to be vol events? The market's not expecting fireworks, and if they do see fireworks, they're going to be fairly short-lived. It's going to be one of those things where it sort of spikes up and then comes back straight back, stops, and liquidity affecting the move. I think in terms of the Reserve Bank, there's every reason why they should. We're not getting any kind of light at the tunnel. The RBA made it clear they had a flexible policy, and with regards to the tapering situation, they decided not at the last meeting not to change, and now we're seeing significant pickup and a consistent pickup in the case count in New South Wales, the most populous and biggest contributor towards GDP in Australia. Victoria's second biggest neighbour now. We're in stringent lockdowns, and so the biggest portion of the GDP of the country is in lockdown. I think we're losing something like $2 billion a day in terms of output. So they absolutely should, but I don't think they're going to. I think they're going to continue to soldier on, and I think they'll make it clear that they're still expecting a snapback in Q4, and I think that they'll leave the taper program in place. So they'll look to lower it from 5 billion to 4 billion. I think they should leave it at 5 billion, but I'm not sure what it would achieve, to be honest, Luke. I'm not sure what's
1 billion really going to do. Yeah, and I think you moved in. Q2 numbers were better than consensus. So you came into these lockdowns on a strong footing. Your vaccination rates are stepping up. You're not as high as us here in the UK, unfortunately, but there definitely is a ramp up there, and that's positive. And as you say, what does 1 billion really do in the grand scheme of things? And I think the bank, they might potentially just look through this as a temporary thing.
Yeah, I mean, I naturally, if they keep it as it is and they taper, given that we don't tend to look so much at Goldman's and Citigroup and those kind of economists. I know when Goldman's makes a claim about QE and the Fed, everyone gets very excited about it. We tend to look at the big four banks here, so NAB, CBA, ANZ, and Westpac, because these four banks effectively have control over the whole financial system in Australia, and they price. They're very close to the central bank. They're very close to monetary policy, and therefore we look at them very, certainly more closely, because so many people's housing and mortgages are tied to these four banks, and three of those four banks are calling for the RBA to push back and to continue with 5 billion. So one suspects, probably I'd imagine the consensus is for them to do a 180 and change tact. So therefore, if we see them continuing with their plans to cut back by $1 billion, you might see the Aussie pop a little bit, and there could be a trade there, but you might see it just come back straight away. So where do you take that profits? And so you might see it drop, pick up 30, 40 pips. The ECB though, and I know that you cover this quite closely as well, but look, my opinion is they continue to soldier on similar to the RBA. So it's going to be, I'll let you write the headlines for that one. You seem pretty good at it. But I think that they got the UBSs of this world calling for them to lower the pace from 80 billion in terms of PEP buying to somewhere closer towards 65, 60 billion. And that would give a very clear consensus view that when the kitty runs out, I think there's about €500 million of the envelope left of capital in that program, that they would let that fizzle out, and there might be, rotate it somewhat into the asset purchase program. My own view is similar to the RBA's one. I think they'll continue to soldier on at the current pace through to Q4, and they'll make a reassessment on that pace in Q1. What do you think?
Yeah, it's an interesting one. You obviously know the RBA better than I do. The ECB, being in the UK, tend to cover it quite a bit. It's a tough one. I think there's certainly no consensus over it. Like you just said, 3 out of the 4 major banks in Australia are calling for basically a delay. But the major banks that have been looking at the ECB sort of thing, there's no major consensus on that. And it's a really tough one to call. We know the ECB loves to err on the side of caution, and they really
Yeah.
are doves. So look, I think if they do taper into Q4, it's going to be a really close call. If they do from 80 billion down to 60, 65 billion, as you said. But I think they could litter that with dovish language. They could back it up with saying, look, if conditions change, financial conditions get a bit more punchy and we're not happy with it, it's a flexible program and we can top it up. There's no problem, because actually, if they tapered 60 billion in Q4, they won't exhaust that PEP envelope come March 2022. And that could continue further on into the rest of 2022. But when the market talks about tapering for the ECB, it's quite ironic, because they're going to transition straight into something afterwards. It's not going to
into the AWP. They'll change it around. So it's not like it's done. We got very excited last week about a 6 basis point move up in German bunds, and that put a bid into the euro. But have a look at the setup now. I mean, we've got this move back into the
top there.
There's a few times that supplies come in around this,
maybe even a triple top
figure.
Westy.
You've got this interesting candle here off that high, and we're seeing if this price. I mean, we've got a lot of liquidity, a lot of the participation coming out, and obviously the bond market's closed, so that takes a natural drive of the FX market out tonight. But if this kicks on through the lows and closes through this 5-day moving average, which has been really defined this bullish trend upwards, then I think we're going to see momentum shift to the downside. You could be seeing a market that's going to run a slightly weaker euro position into the ECB meeting, and that would probably be in line with the view that I have tactically, that I think at the margin that they'll continue to push on. We got very excited by a number of the ultra hawks on the ECB meeting, talking about cutting back on the pace sooner rather than later. These are well-known hawks. But like you say, when it comes to people like Lane, when it comes to people like Christine Lagarde, what actually happens in the meeting could be a very different thing. So I wouldn't be surprised to see this market getting pretty excited from some of the hawks, a kickback through these lows that we saw down here. So the lows came in around 118.65, and a close through this 5-day exponential. And I wouldn't be surprised if we saw the market running a slightly more short euro position into that ECB meeting.
I think if they do actually delay and don't taper and they sort of sit on their hands, I think you could actually see a tiny bit more supply come into that resistance level that you've just shown on the chart, for sure. Moving slightly away from FX markets, what is your outlook for gold? Have we peaked? And oil, the two hottest commodities at the moment?
Yeah, difficult one. Obviously,
I'm a gold bear. You know that. I'm just going to get that on the open for all our viewers now. Medium term, shorter term, more difficult to judge. But over the medium term, I think gold, the conditions aren't conducive to bullish gold price action.
Well, you've lost a lot of friends, I think. Again, let me bring up. If I'll just bring up my screen. I'll just have a look at the chart on gold, because big move up on Friday, as you can see here, and again, it wasn't really conducive of that sort of behavior, because real rates went higher, less negative. The dollar came well off its lows, and actually, if you look at the interest rate markets, there was about 1 basis points being priced out of hikes. For 22, but 24 for 2024, they actually increased rate hikes off the Fed meeting, off the payrolls. But yet, gold price had a really nice move off this 200-day moving average. So, really, really interesting behaviour. We're now at these highs, and the market doesn't really know what to do here. So for me, I take a slightly different view. Again, coming to my idea that when the flow of capital is all moving in one go, I'm quite hesitant to trade here. But if we get a close above that, and it certainly starts to kick high, I'd definitely be going along for the ride there, because it's told you that this supply level is being given way, and I would trade that from the long side as a short-term trade. I think longer term, I completely agree with you that I think the inflation expectations are probably reasonably capped. They might have a little bit more upside, but maybe we see a sell-off in the bond market, in which case real rates go less negative, in which case I think gold prices go lower. But right now, as a trader, I can't do much, because until we see, if price rejects this level now, then I think that could be very telling indeed, that we've come back into this supply zone. The sellers have kicked in, and we start making a move. If we can get through these lows again around 18.07, then you'd probably be looking to add to those shorts. But for now, if it can close above this level, 18.33, then that would be a very powerful statement for me, and I'd probably be looking to go long as a short-term trade. If I have a look at the oil markets, on the other hand, that looks a little bit more precocious. We tried to make high. You can see a little bit of supply coming into the market above $70, and this is US crude as opposed to Brent crude. So I think really, if in terms of Brent crude, if we can get a move through around these kind of levels here, and bear in mind, I should go to US crude, the average production rate that the US producers are producing is around $34. So there's still decent margins there, and room for it to come back down to better levels. So I think this is quite a bit more vulnerable. If this global growth story that we talk about is genuinely going to show concern, then crude's going to be at the heart of that. Crude is so essential to the global financial markets. Gold is more of a sort of byproduct of and second derivative of other markets that are going around. But I think crude is really essential to everything that we're seeing in terms of S&P, in terms of FX markets. And so I'd be watching crude very, very closely. If that rolls over, that's going to have huge impacts for all asset classes. So yeah, I'm watching crude like a hawk. I'm prepared to trade gold. It's probably the best way, I think, for this.
Okay, yeah, crude's interesting at the moment because we got those monthly OPEC meetings, and we just saw the recent one that they decided to send Joe Biden's call for hiking production even more straight to voicemail, and they stood with their 400,000 barrels a day every month. But that could obviously change depending on market conditions. And then we've got interesting hurricane season, Hurricane Ida, and that's shut in quite a lot of production. And what weirdly we actually saw, which I wasn't expecting at first, was we saw a bit of a sell-off when that production was shut in. And what the research I was doing showed that they thought that supply was going to come back faster than refineries, and that's obviously the demand side. So there's a bit of a mismatch short term on the supply demand side.
Yeah, I think they're making quite a big assumption on demand by increasing production by 400,000 going forward. We are going to see a supply demand surplus in 2022. So next year there's going to be a surplus. At the moment, they're fine in increasing production and output because they've got room to do so. But as we go into 2022, that equation changes, and we will see greater supply relative to demand. And so therefore, if they get the demand side of things wrong, which is why we're looking at crude as such an important proxy of global growth, that if they get the demand assumptions incorrect while they're increasing supply, then you could see a fairly aggressive downside move in crude. So this is the gamble that OPEC are making, OPEC Plus are making, is that the demand assumptions that they're working with are going to hold up. If they're wrong while they're increasing output, as I say, then you get a move back to that marginal cost of production, which is around sort of $34 on average in US producers. I know OPEC control the Brent price more effectively than US crude, so that's obviously a dynamic that you could play between Brent and US crude. And a lot of pro traders do that, but that's a really interesting one. Is what happens there in terms of their perception. So yeah, use it as a really clear global growth story, which is why we watch crude as a byproduct of kind of cyclical areas of the stock market as well. So a really interesting one.
Westy, the viewers are really getting their money's worth of you today. I'm putting on the spot here. Geopolitics, commodities, central banks. The next question, and that I think also maybe might filter into the ECB, maybe potentially with the volatility we're seeing in the German elections. So we got the German elections are less than a month away. The SPD, centre-left party, have really opened up a decent lead over the incumbent CDU-CSU. What are your thoughts on what many are now saying could be a three-party coalition at the helm? Does this add a risk premium for the euro given Germany's size in the EU, or does it boost the euro based on the expectations of fiscal policy taps being opened more aggressively? However, there will be more regulation, I would assume, and tax increases, which could net off the benefits derived by larger government spending. Bit of a mouthful there, but give us your thoughts.
Yeah, look, I'm a very simple man, Luke. Look, I think what we as traders have shown, I know a lot of people will disagree with me because they'll say, oh no, we picked it, is the market more broadly has been incredibly poor at pricing risk around elections. Even when they get the right outcome, they quite often have priced the risks and the market reaction poorly. Yeah, we've obviously got a number of playbooks that we can run in the US and the UK. Is the German election going to be a similar situation? I don't think so. Have a look at, the VIX of the DAX. It's trading at 17%. It's near 52-week lows. No one is telling you that they expect implied volatility or expected movement in the German stock market to increase. A lot of, we need to remember that. I know on the 20th of September, there's going to be changes. There's going to be 10 new constituents going into the index. And 80% of earnings or sales, should we say, coming through the DAX is going to be derived from offshore. So it's kind of less sensitive to domestic cyclical factors. If we were to see the SPD, the Green Party, and probably the FDP as well, forming a coalition government, what will that mean? And how long will it take as well? I mean, I think one of the big factors is how long it actually takes for negotiations for a party to be formed. And, it's not just the Chancellor, but also the parties as well. Now, I was looking at the betting odds, and the firm favourite is a coalition government between the SPD, the Greens, and also the FDP as well. I think the market would struggle to really understand how that means, because that would be a slightly centre-left policy mix. That said, we are now seeing the SPD poll very well. And they are pulling ahead. So will they get enough to form a coalition with the Greens? I'm not sure. I think they need 50%. But I think there's all these different permutations that the market at the moment.
Yeah, I mean, some of them have been so confusing. As they're calling it Jamaica traffic light. It's so many different permutations that could potentially arise. And it'll be an interesting one, that coalition that you mentioned, that the betting markets are putting the most weight on, with the SPD and the Greens, because obviously, the FDP, they are quite right in terms of economics. They are fiscal hawks. They want to bring back that 60% debt break right back in. So it'll be interesting to see how those parties would work together in a coalition for sure. I think, the CDU, CSU made quite a bad mistake in terms of choice of their candidate. Marcus Soda, who was running against Lachey, was looking, he's far more popular amongst MPs and voters, and they I think the CDU chose an establishment candidate, the higher ups, and now they really are they're bearing the brunt of that poor decision.
That's what they're saying, exactly. So
Euro-wise, net, what do you think if we get that coalition, that the book?
I generally think that this is one of those ones. It's just the too hard basket for a lot of internet. I think there's a lot of people now just running the ruler over this and go, what does this actually mean? Should we have this on the radar? If you're an international trader, you're thinking, is this going to actually be a risk event? Do I need to have this on the radar? Do I actually need to do some homework around this? I mean, you and I have done a little bit. You've probably done a bit more than I. And I'm not seeing this as a volatility event, rightly or wrongly. I'm not seeing this as a massive game changer. Obviously there's things that we need to be concerned about. Is it going to take a long time to form a government? Could we see a situation where the government move away from fiscal restraints and the disciplined fiscal approach they have, perhaps? But I don't think international money managers they're probably doing the homework now, as opposed to when we saw the last US election, where 5 months into it, everyone knew exactly the different playbooks and what they all meant. So I think this is I don't see this as being as a major changer. I would love to see a situation where we see a market friendly outcome, and it moves to a world where it incentivizes the ECB to do more. I want central banks to start causing gyrations in markets and invoke some volatility in markets. I'm not sure if the German election is going to do that, though.
Well, we may get it from the French elections in April 2022, because I think those are going to be a lot more interesting, with Marine Le Pen breathing down old Macron's neck. But enough about geopolitics. Let's move on to the most exciting part of the show, and that is, what is your favorite trade idea at the moment? The one that you kind of have the most conviction about, and then maybe just run us through how you arrived at that, and what is your process in terms of making that decision, Westy?
Yeah, look, I think there's I don't really have one trade that screams, Chris, come and trade me right now. There's a few things that are jumping on my radar that I want to watch. I talked about the Aussie dollar. I talked about the euro. Are we going to start seeing people run a short euro position? I did see that Brazil are going to stop exporting cattle to China because they've seen a few cases of what looks like mad cow disease in Brazil.
Oh God.
And if I share my screen, this is getting a bit exotic.
Certainly, indeed. What are you going to pull up next? The tar baht and some exotic currencies in that world, Westy.
If I have a look at cattle prices here, they've been coming under a bit of pressure. If I look at cattle futures.
I mean, you are a cattle man, eh? You've heard of cattle.
I'm a cattle man, yeah. Yeah, you can see on a little bit of pressure, but yeah, I wonder if this news, obviously CME's closed tonight, so I think there's partial trading. I wonder if we're going to see a bit of a change. I want to say a bullish reversal, but then that would be ultimately very cheesy. So I'd be looking at that. That could be an interesting trade. What I love about agricultural commodities is when they go, they absolutely go, and they trend absolutely beautifully.
Yeah, we saw that with lean hogs, didn't we?
We did. Let me just move this out of the way. Have a look at this though. This is the positioning in 10-year treasuries in the futures. So this is leveraged accounts. These are the people like you and I that, well, probably a bit more sophisticated than us, but they're hedge funds effectively.
Don't sell us short, Westy. Come on, don't sell us short.
Yeah, they're still very long. Treasury futures, 272,000 contracts there. You can see asset managers here are long as well, 132,000 contracts, whereas other reportables and dealers who take the other side of that are short. So the people who move money around are still very, very, very long of US treasuries. So that's one aspect. We can also see here that the curves are starting to steepen. As I talked about the jobs but plentiful versus jobs hard to get, I've actually flipped. You can see here, I've sort of gone down a rabbit hole, but what we can see here is that as part of the consumer confidence report, one of the questions is do you see jobs plentiful or jobs hard to get? And you can see here when this is moving up that more respondents are saying that they're seeing the labour market as plentiful. There's lots of jobs available. And this is near an all-time high. And look at the spike that we've seen here. So that does not marry up with what we've been seeing. But if you have a look at the back end of the curve, I've flipped this upside down. So this is actually going down. What we should be now seeing is the yield curve starting to steepen. So 10-year treasury is starting to move up quite nicely. And we're starting to see that now. You can see that 10s are underperforming 2-year treasuries. There's a whole heap of evidence now, just the way that the 10-year traded. I know a lot of people here who are watching this don't really understand the bond market, but for me, it's really, really essential when in FX markets. And you can see the price action that we saw on that payrolls number there. So despite a really poor payrolls number on a headline jobs number, there's still really strong growth. So I think that rates go up now. I think that we're going to see a lack of buyers moving in, and I think that yields go higher, so prices go lower. And I think if we can break through this 137 region, I'd be looking to add to shorts now. We don't offer bonds at Pepperstone per se, but what we do offer is ETFs. So you can trade this through the IEF, which is the 10-year treasury, or the TLT. So I like being short both of those right now, based on the price action that I'm seeing, based on the position that we're seeing in markets. I know there's been a lot of false starts. People have tried to short bonds, and they've just got false starts. And obviously with the global growth story being quite precarious, being short bonds effectively is a play that that global growth is going to improve. So a lot of people will completely go against what I'm saying. But markets are dynamic. We live in the future as traders, and we've had every opportunity to move recently, and so we're living in the future, and we've had every opportunity to price in the global manufacturing numbers, the payrolls numbers, all the other factors that are playing through, and therefore you see the TLT here. I think if yields continue to go higher, I think there's a good trade here. To be honest, I think I like to be short. Short the TLT in this environment. I think it's going down.
And high yields obviously is rocket fuel for the dollar yen currency pair. Do you want to maybe just pull up that chart and take us through that a little bit? And my home currency, the South African rand's been on an absolute tear after its weakness around mid-July, early August. It's been on an absolute tear. US dollars are.
Yeah, I mean this is mirroring it quite nicely, but there's no real trade here. You can see that it's going sideways. I mean, you could probably flip.
Got like a bit of a triangle pattern forming, I think, there, where you're getting the lows and everything, sort of the lows, higher lows.
Yeah, exactly.
Highs.
It's consolidating. Basically, when I look at dollar yen right now, I'm not seeing any kind of the bulls or the bears are really just not making their case heard. They're not prepared to really push price around. This is one where you get the mean reversion hedge just going, do you know what, we're going to stick a Bollinger Band on there or something. We just put a couple of lines and just look at the range, and let's trade the range that we got coming through. And I think this is the way you play this at the moment. And when it does break out, that maybe then sets off a trend. So there's no real conviction in that at the moment. And I think that's also a reflection of rates. But I just think that the way that the 10-year traded on Friday, everyone was expecting a bad number. Everyone was positioned for a downside underperformance on the payrolls, but we've seen yields moving higher. I think if we see people believing that this Q3 data that we've seen, which has been poor, is a low and it's been affected by COVID, and we do see reopening, I think yields go higher. And I think that could be good for dollar yen. That could see dollar yen break out. It could be good for the dollar, and it could give conviction to the Fed. So at the moment, we're all sort of talking about this divergence between growth in Q3 and risk assets, and that doesn't reconcile well. But we're also saying to ourselves, well, what happens if Q4 does really snap back? Some people will disagree with that. Some people agree with it. It's what markets are about, isn't it? It's about it's finding a balance, and people will express those views in the markets because that's where we live. We live in Q4, we live in Q1, we live in Q2 of next year. We don't live in Q3. We don't live in the past. So that's what we're trying to understand, and that's probably why you're seeing a messy tape in dollar yen, because people are trying to understand what it means, and they can't see a clear picture. If they saw a clear picture, this would probably be trending by now.
Mm-hmm. Westy, I think we've done a ton of stuff today, and it's been a very successful third episode of Buy the Dips. I'm sure the viewers have found it very insightful. We've done a sort of whirlwind of different topics. Thank you very much for coming on. And it's been great.
Well, I appreciate being asked. I think we've probably gone way over time, so good luck to everyone who's stayed on this length of time. But yeah, it's a really interesting one. And if anyone's got any questions for Luke or myself, drop them in the comments field. Give us a like if you can. But yeah, obviously, if you've got any questions for myself or for Luke as well, we're all ears. Just drop them in the comments field or get in touch with us on Twitter.
Alrighty, perfect, Westy. Thanks for coming on, mate.